U.S. manufacturers just issued a frightening warning. I'm Steve Van Metre. Orders are crashing, costs are soaring, and layoffs are set to skyrocket as you're about to see the U.S. economy is screwed. And while there's Buy the Dip, my subscribers are up 8% in 11 days. Stay tuned to the end of the show to learn how you too can beat the machines for big profits and jump in on our latest big trade. Now let's head over to the S&P Global, where we find out it's not just the U.S. economy, but all of Europe's is screwed as well. As S&P Global notes with their flash U.S. Purchasing Manager Index that output growth revives in March, but confidence in the outlook, that's for the future, deteriorates further. And this is all about the tariffs, because what happened after the election is we heard that manufacturers were saying that there's all this pent-up demand in the economy, and that in turn led to a surge in new orders. It led to hiring, and then all of a sudden it was all about the tariffs. And what we saw then earlier this year is a lot of front running in demand. We said this would leave a big hole in the U.S. economy, and now all of a sudden S&P Global saying demand in the future is outright plunging. And let's take a look at the details, because the U.S. Services PMI came in at 54.3. That's a 3-month high, indicating that the service sector demand is rising. But the risk here is to the manufacturing sector. And this is important to understand, because even in the short term, you can see the services sector rising. But the issue is where manufacturing goes, services follow. There's two key reasons. One, of course, jobs in the manufacturing sector pay more, but the services sector sees 70% of their revenue come from manufacturers. And look at this, a 3-month low in U.S. manufacturing as it enters a contraction at 49.8. Again, under 50's contraction, over 50 in expansion. And here's the interesting part. This data was taken in early March. So all of a sudden, all of that excitement over front-running tariffs and all the demand in the factory sector that a lot of the media said this was a turnaround in the U.S. economy, we said that wasn't going to happen. It was transitory. And sure enough, now manufacturers saying their outlook over the next 6 months plunging to ridiculously low levels not seen since October of 22. And business expectations for the year ahead fell to their second lowest since October of 2022, as companies grew increasingly cautious about the economic outlook, often citing worries over customer demand and the impact of aspects of the new administration's policies. Now, it wasn't long ago, what did manufacturers say is that people could afford higher prices and they were going to push those onto consumers. And then we heard from the Fed, and what did they say? That the labor market is strong and robust, and it's okay that we see a little bit of a pullback here in demand because the economy is set to surge higher. But now all of a sudden, manufacturers are waking up to exactly what we've been saying, is that when payrolls start to shrink and we see that take-home pay goes down, which is exactly what's happening against higher prices, it leads to less demand, and that means for the outlook for manufacturers, it's outright plunging here, telling us that the U.S. economy is screwed. But again, it's not just us. We're going to take a look at Europe, and you're going to see the same thing. And job growth was also subdued amid heightened uncertainty about the outlook and concerns over rising costs. So in the past, what have we heard from manufacturers? That they're going to push these higher costs onto consumers. And we said, wait a minute, consumers can't afford prices where they're at now. They most certainly aren't going to afford them at even higher prices. And so in the beginning of this, what happened is manufacturers took a hit at the margin. Now they're saying, look, this is an issue here. We can no longer take any further hits to our margin. When companies do that, it means layoffs are coming. That's why the U.S. economy here is screwed in the short term. But I want to know from you, do you work in the manufacturing industry or somehow tied to it? Are you seeing hours get cut? Are you seeing people worried about losing their job? I want to hear from you. Weigh in the comments below, because input price inflation accelerates sharply, especially in manufacturing, now to a nearly 2-year high. It's often attributed to the impact of tariff policies. Now, to me, this is interesting because, yes, we've had some tariffs go into place, but the big ones are coming on April 2nd. And yet, despite all of that, input costs are surging higher here. And now manufacturers are waking up to what we've been saying, is that demand is plunging. Consumers can't afford it. Their paychecks are shrinking, and suddenly it's about to hit. But competition limited the pass-through of higher costs to selling prices. So it's notable here, everybody thought the U.S. economy was going to boom. But what happens when demand goes down, it means competition for new orders goes up. And that means businesses who don't want to take a hit at the margin are now forced to. And that means other businesses are going to lose out on business they need. That's going to put workers on the unemployment line, as you're about to see. Let's first take a look at this chart of corporate profits after tax. That in blue on a year-over-year rate of change against continued unemployment claims. Let's go back to the late 1980s. What happens? You see a deceleration in corporate profits, ultimately a contraction, and as businesses see their profits go down, well, that means it's passed through on to workers. Demand is falling. They send people to the unemployment line, and that means no opportunity to re-enter the workforce because declines in corporate profits mean demand is going down across the economy. We see that happen again in the late 1990s as profits contract. You can see the hit to the labor market in terms of continued claims. And then as the economy looked to rebound, well, employers hired back only to see their profits re-enter a contraction. That sent workers to the unemployment line where they got stuck there, and you see continued claims surging higher into the dot-com bubble. Let's move forward to the global financial crisis at around 2006. You see profits decelerating into a contraction. Employers hang on to workers for a little bit, then they start to send them to the unemployment line en masse. And this is exactly what we're seeing right now. This is my concern of why I think the U.S. economy is screwed. I want to know from you. Weigh in the comments. Do you think our economy is screwed? Do you think this all turns around? This is a temporary hit? Again, weigh in the comments. I want to know, because right now what we're hearing from manufacturers is their profits are going down, likely to contract as their outlook plunges to the worst since 2022. Well, what happened in 2022? Here you can see profits were in a contraction. And what was the response? People hitting the unemployment line. And by and large, those that did are still stuck there now. And manufacturing output, meanwhile, fell into a decline, contrasting sharply with the gains seen in the first 2 months of the year. Of course, we look back, this had everything to do with front-running of tariffs, and we said this was likely to happen. The problem is, once all of this inventory building was done to buy as many things ahead of the increase in tariff prices, well, what happens next is demand plunges, utilization of factories goes down, and that means you need less workers because you don't need people standing around. And factories reported fewer instances of output having been buoyed by front-running of tariffs, and new order growth came in close to stalling in the goods-producing sector. So now what they're noting is that fewer people are front-running the tariffs because their inventory levels are too high. And what is the response? A stall out in new orders. Again, this is very dangerous for any economy. Let's take a deeper look. Here we have capacity utilization in blue against continued unemployment claims in red. Now remember, back in the late 80s, you saw profits decelerating, contracting. Look what happens to capacity utilization. And again, this is a percentage of a factory that's being utilized. It's going down. That means you've got workers staying around because you don't have enough work for them, so you send them to the unemployment line. There you see continued claims heading higher. We see the same thing happen in the late 1990s as capacity utilization along with profits were headed down. That sent workers to the unemployment line with no opportunity elsewhere to get jobs. It happens going right into the global financial crisis. You can see the recession starts officially, and then capacity utilization just falls right through the floor. That means workers on the unemployment line, no demand to put them back into the labor market, and we're into an all-out financial crisis. And as manufacturers are already noting, demand is going down because there's a stall in new orders. That means the U.S. economy headed right into a recession. Let's take a look at what this means for the average worker as we see new order growth go into a contraction. It means there's going to be a lot of layoffs. Now we've got durable goods new orders in blue against continued claims still in red. Back to the dot-com bubble, what do we see? A slowdown in new orders that eventually contract, and that contraction in demand means that workers in the manufacturing sector aren't needed and have no opportunity elsewhere to get work. We see that going into the global financial crisis going back to 2006. Demand has slowed down a little bit. It impacted the labor market at first, but not a whole lot, just slowed down the growth rate, and then all of a sudden you see new orders are headed down at a very quick rate. That meant workers to the unemployment line. Again, no opportunity to get jobs as somewhere else in the economy. Here we see it again going into the pandemic. New orders collapse, enter a contraction. You see the hit to the labor market, and look what happens now. We talk about 2022. Again, that was when profits went negative, but look, you see that decline in new orders? It led to an immediate increase in continued claims. Now, what we're hearing from S&P Global, new orders flatline, outlook poor, meaning this is likely to head lower and workers going to hit the unemployment line. It gets very clear the U.S. economy here appears to be screwed. I want to know what you think. Do you think our economy is screwed, or do you think we pull this out? Weigh in the comments below, because regardless of where the economy goes, you can make money trading. This is a trade for Brazilian equities we put onto our CTA Timer Pro subscribers earlier this month. We told them to buy in the open on that red candlestick, and what did we note? That momentum was trending up, price was trending up, but the big issue for our CTA Timer Pro subscribers were the machines were set to buy. This shot the price right up to its 200-day moving average. They're currently up 8% on that trade, and you too can join in and make money trading. Hit the links in the description below. Grab that free 30-day free trial coupon, because we just put on another trade a couple days ago. This one I jumped in on today too. Let's find out. Subscribe and join us in making money in these markets, because manufacturers in particular reported concerns over payroll numbers and rising costs, cutting headcounts for the first time since last October. And that's the issue here. Manufacturers are seeing demand goes down. That means they've got to compete. Their prices on the input side are going up. They're being forced to pass it on to consumers, but there's only so much consumers can handle. And that means when you've cut all your other expenses as a business, you start cutting hours, and then you cut jobs, because you've got to cut as much expense as you can to be competitive, because again, less demand, a lot of people want it. Well, that means you've got to cut your expenses. Higher costs fed through a steeper rise in manufacturing selling prices, which rose in March at the sharpest rate for 25 months. That tells us the consumer price index headed higher. The March survey also saw a modest acceleration in services selling price inflation. Again, it's suggesting inflation across the board going up. And we can look at this chart of continued claims in red against the consumer price index in blue. That's shown on a year-over-year rate of change. You can see what happens when prices go up and people are on the unemployment line, where they see their take-home pay shrink even further, meaning they have less money to spend in the real economy. That puts other people out of work. You spiral right into the 91 recession, right into the dot-com bubble, right into the global financial crisis. You can see the recipe here. And now, what are manufacturers and service providers saying? The prices are headed higher. At the same time, they're looking to cut payrolls. That means continued claims looking to move to the upside. The evidence is mounting. We're heading right into a recession, just like we have in the past. Let's look at this, because the key concern over tariffs is the impact on inflation, which a March survey indicated a further sharp rise in costs as suppliers pass tariff-related price hikes onto U.S. companies. I want to know, are you concerned that prices are going to go up even higher than you expect? Weigh in the comments below. I'd love to hear from you, because firms' costs are now rising at the steepest rate for nearly 2 years, with factories increasingly passing these higher costs on to customers because they have no other choice. But again, demand here looking to plunge. That's my base case. If we see higher prices, rising unemployment, and profits re-enter a contraction, it's a foregone conclusion to me what happens. But let's take a look at Europe, because I don't think it's just the U.S. economy here is screwed. I think it's going to be the entire world. As German growth buoyed by upturn in manufacturing production, let's take a look at this, because now you see a 31-month high in the Germany manufacturing PMI, as it contracted at a less worse rate at 48.3. So for 31 months, we've seen German manufacturing contract, and things right now appear to be settling down, that perhaps there's a bottom that's forming across the European manufacturing sector. I'm going to make the case of why this is only temporary before another big move down. The upturn in manufacturing was driven in large part by stronger demand in the sector, with goods producers reporting a first, albeit modest, rise in new orders since March of 2022. Where an increase was recorded, some firms remarked on stronger domestic demand and clients trying to build up stock. So there's, again, evidence. Let's build up inventory ahead of tariffs, because this is easy. If you're struggling, if your business is already hurt at the margin, and we see that based on the profit data, well, what you do is you buy as much as you can at current prices, and then when the tariffs hit, you raise them to try to increase your profit margin. At least it works temporarily. The problem is, if nobody buys it, you don't make any money. And March saw a further broad-based reduction in backlogs of work, a sign that the pressure on business capacity. The rate of depletion was unchanged from the solid pace recorded in February. So once again, what do we see? not enough work in terms of new orders to keep workers busy. They get positioned on backlogs. We still don't know when, but at some point these backlogs are going to dry up, and without enough new orders to keep people busy, there's going to be mass unemployment in the German manufacturing sector, and that's going to spread all across Europe. And again, I don't think the U.S. is immune here by far. Labor market conditions reflected this, with March seeing a 10th successive month decline in employment. So there, my friends, you have the evidence. Again, not enough new orders, backlogs going down, 10th straight month of people losing their job. And again, I think that's going to accelerate in a major way. And sentiment towards future activity improved slightly at the end of the first quarter, as growth expectations increase in both monitor sector and remain stronger in manufacturing and services. But check out why. Reports surveyed from businesses highlighted positivity around a boost in infrastructure spending in hopes of general upturn in economic conditions. Well, we forget the latter, because there's going to be no upturn in general economic conditions as we face another round of tariffs starting on April 2nd. The real issue here is infrastructure spending. Now, what happened in China? Remember, the Chinese government came out and spent a bunch of money in the economy. And how long did that last? A matter of months before everything turned down. And what are we going to see in Germany? The same thing. Excitement over infrastructure spending is going to create some opportunity. And when that money dries up, look for, of course, more people there to lose their jobs. You're seeing not just the U.S. economy, but now also the German economy headed into stagflation. But not to be left out, France is right along the same path, as you see their manufacturing PMI came in at 49. As you see, their manufacturing PMI came in at 48.9. That too is a 26. As you see, their manufacturing PMI came in at 48.9, a 26-month high. So again, not as bad as before, but still in a contraction. Again, all this data from early March. And as been the case on a monthly basis since May of 2024, total new orders received by surveyed private sector companies shrank in March. The decline was less severe than the previous month, reflecting slower falls in new business receipts. So again, declining new orders. We're seeing backlogs work through. What do you think is coming for the French manufacturing sector? Layoffs. Backlogs of work were down further at the end of the first quarter, extending the current period of depletion to 20 straight months. And according to panel members in both monitor sectors, projects pending completion were cleared due to a lack of incoming new work. And there's the issue, a lack of incoming new work. We're seeing that in the U.S. manufacturing sector, in Germany, in France. We're seeing that happen in China and other parts of Asia. Demand is plunging because, again, you go back to the pandemic. We stimulated the economy. We pulled demand forward. Then the tariff threat came along, and what happened? We pulled demand forward. At some point, there's a price to pay, and that is coming soon. And we see this as the longest sequence of job shedding since the late 2020s, as workforce reductions were exclusive to the services sector, as factory staffing levels rose for the first time since May of 2023. But my concern is that we're going to head into recession long before any of that actually is accomplished. But again, want to know from you, do you think he pulls it off, or do you think it's too late? We're already headed into a recession. Weigh in the comments below, because despite the fact the economy may be headed down, doesn't mean your trading account has to go with it. Let's take a look at this trade on Brazilian equities put back to our CTA Timer Pro subscribers on the 10th of March. You can see that trade up 8.14%. Here were the notes we gave. We said buy it open. Here's your upside target that we hit, and we even give them risk control levels right along the way. Here you can see buy it open on that red candlestick, and next thing you know, it's taking off to the 200-day moving average, potentially looking to head even higher. So how do we do this? Each and every day we look at machine positioning across a broad equity, bond, currency, and commodity markets. But what's unique is we run a historical overlay, so we find out when the machines need to buy and when they need to sell, so we can position our subscribers to buy ahead of the machines and sell before the machines cut and run. And it's all, again, integrated right into the reports. And we look for these discrepancies, particularly where the machines are at max short positions and have to buy. And when that triggers, it's a great opportunity for our subscribers to make big money. Now you get the report, you get all the tradable signals. I review the trades and tell you which ones I think are the best. Again, all that historical data modeled into our program. We give you risk control levels, a full tracking of all of our open trades and returns, a weekly update, full disclosure on my trades. And yes, I just jumped in on one of those today that we flagged 2 days ago. You can get on that too. Plus, we give you a 30-day free trial. Why is that? Because we're so confident you can make money trading our reports. We want your first 30 days to be on me. Grab the links in the description below. Use the coupon code for that free 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.